If you trade a small account like a lottery ticket, it will die like one. You already know this somewhere in the back of your mind. You've seen it happen. Maybe you've lived it. You deposit your hard-earned money into a trading account. $2,000. $5,000. It doesn't matter the exact amount, because the pattern is always the same. You feel that pressure immediately. The voice that whispers, "If I don't size up, I'll be stuck with this tiny account forever." So you force it. You think more risk equals faster growth. In reality, more risk with a small base is the fastest mathematical route to zero. Most traders with small accounts don't fail because they're stupid. They don't fail because they can't read a chart or understand what a moving average does. They fail because they violate the one mathematical law that separates amateurs from professionals. Survival comes before growth. Not after growth. Not alongside growth. Before growth. Survival is not negotiable. Growth is optional. Let me be brutally honest about what happens next. You open your trading app and see that balance sitting there. $2,000. It doesn't feel like much compared to the social media traders posting screenshots of $10,000 days. You tell yourself you're serious now. No more playing around. You spot a setup that looks perfect. Clear trend. Clean breakout level. You've watched 3 YouTube videos about this exact pattern. You decide to go meaningful on this trade. You risk $400 because you need meaningful size to grow. That's 20% of your account. But you don't think of it as risk. You think of it as finally giving myself a real shot. The trade goes against you. Not because the market hates you personally. Not because some algorithm targeted your specific position. Simply because losses are a normal, inevitable part of trading. Price taps your stop loss. You're out. One trade. One completely normal loss that happens to every trader who trades long enough. Your account balance now reads $1,600. You didn't just lose $400. You lost safety. You lost flexibility. You lost emotional stability. And most importantly, you walked voluntarily into a mathematical prison that most traders never escape. Here's the brutal math that kills small accounts, and it has nothing to do with indicators, patterns, or secret strategies. When you lose 50% of your capital, you don't need 50% gains to get back to even. You need 100% gains just to break even. If you fall from $2,000 to $1,000, you now have to double that remaining money just to crawl back to where you started. That's not a trading challenge. That's mathematical imprisonment. Let me show you exactly what this looks like with real numbers. You start with $5,000. You take a trade that goes wrong and lose 20%. You're down to $4,000. To get back to $5,000, you don't need to make 20%. You need to make 25%. Lose another 20% from $4,000, and you're at $3,200. Now you need a 56% return just to see your original balance again. Take one more 20% loss, and you're sitting at $2,560. You now need a 95% return to recover. 3 bad trades, and you need to almost double your remaining money just to break even. This is why most small account traders never make it past 6 months. They don't blow up from one catastrophic black swan event. They die from 3 or 4 normal losing trades where they risked too much. The mathematics become impossible. The psychology becomes unbearable. They start making decisions from desperation instead of discipline. Picture 2 traders with identical $5,000 accounts. Same market. Same broker. Same educational background. Same access to information. The only difference is how they think about risk. The amateur trader risks 20% per trade. He's aggressive. He wants to grow fast. He believes in his analysis. His first trade loses. He's down to $4,000. His second trade loses. He's down to $3,200. His third trade loses. He's now sitting at $2,560. 3 consecutive losses. And 3 consecutive losses happen to every single trader who trades long enough. It's not a matter of if. It's a matter of when. He needs a 95% return just to see his original balance again. His emotions are destroyed. He's desperate. He starts revenge trading. He abandons his rules completely. He chases trades that don't meet his criteria. He doubles down, trying to make it all back in one heroic trade. Within weeks, the account is mathematically dead. Now look at the professional trader. Same $5,000 starting balance. Same market conditions. Same 3 losing trades, but she risks 1% per trade. That's $50 of risk per trade. After her first loss, she's at $49.50. After her second loss, she's at $4,900. After her third loss, she's at $48.50. 3 losses hurt, but she's still completely functional. She's still thinking clearly. She can still execute her strategy. Let's push this to an extreme that almost never happens in real trading. Let's say she hits 20 consecutive losing trades. 20 trades in a row that all fail. After 21% losses, she still has $4,017 left. She's annoyed. She's frustrated. She might question her strategy. But she's not broken. She can still think objectively. She can still follow her rules. She's still dangerous to the market because she still has her chips at the table. The amateur is already out of the game after 3 losses. The professional survives 20 consecutive losses and still retains over 80% of her capital. That's the mathematical difference between survival and extinction. Here's what reveals everything about your trading future. The question you ask when you see a setup tells me whether you'll make it or not. The amateur asks, how much can I make on this trade? The professional asks, how much can I lose and still be trading next month? The amateur is focused on the upside. The professional is focused on survival. And here's the paradox that takes most traders years to understand. The trader focused on survival actually makes more money in the long run. Not because they're smarter, not because they have better analysis, but because they're still trading when the amateur has already blown up and moved on to complaining about how the market is rigged. I've watched this pattern hundreds of times. A new trader opens a small account. They're excited. They've done their research. They understand technical analysis. They can identify support and resistance. They know about risk-reward ratios. They think they're ready. They take their first trade and risk 15 or 20% because they want to see meaningful returns. If they win, they feel invincible. They increase their risk on the next trade. If they lose, they feel like they need to make it back quickly. Either path leads to the same destination, account death. Within 3 months, maybe 6 if they're disciplined about taking breaks, the account is gone. They tell themselves trading doesn't work. They say the market is manipulated. They blame their broker, or the algorithms, or the market makers. But the real problem was simple and fixable. They violated the mathematical law of survival. When you risk 10%, 20%, even 5% on a trade, you think you're being bold and aggressive. In reality, you're destroying your decision, making ability. A large position size hijacks your nervous system. Every 1-minute candle starts to feel like a referendum on your self-worth. You stare at the screen obsessively. You move your stop loss just a little bit when price approaches it. You close winning trades too early because you're terrified of giving back unrealized profits. You hold losing trades longer because you psychologically can't accept being down that much money. High risk amplifies fear and greed to dangerous levels. Controlled, small risk contains these emotions and keeps them manageable. At 1% risk, your stop loss can trigger, and it stings, but it doesn't destabilize your entire emotional state. You can honestly say, that was just the cost of doing business. That sentence is not available to someone who just lost 15% of their account in one bad trade. That person is now negotiating with reality. And once you start negotiating with your stop loss, the market has already won. The counterintuitive truth that changes everything. The fastest way to double a small account is to risk the smallest amount possible per trade. Not 5%, not 3%, 1% maximum. This sounds conservative. It sounds impossible to grow with. It sounds like it will take forever. But embedded in this single rule is a mathematical edge that compounds safety with explosive opportunity. When you risk 1%, you can afford to be wrong repeatedly. You can afford to learn from mistakes without career-ending consequences. You can afford to wait for perfect setups instead of forcing marginal trades. You can afford to let your winners run without fear of giving back profits. You can afford to cut your losers quickly without emotional devastation. The professional understands that any single trade is meaningless in isolation. What matters is staying alive long enough to let the mathematical edge of a good strategy play out over hundreds of trades. 1% of $5,000 is $50. 1% of $50,000 is $500. 1% of $500,000 is $5,000. The percentage stays constant. The dollar amount grows as your base grows. By protecting the base when it's small, you give it the chance to become large enough that 1% becomes serious money. Over the next sections, I'm going to show you exactly how 1% position sizing creates asymmetric returns, where your winners dwarf your losers even with a losing win rate. I'll give you the 10-second calculation that prevents emotional trading and ensures you never accidentally risk more than 1%, no matter what the setup looks like. I'll reveal the pyramiding technique that lets you scale into winners and capture massive moves without ever breaking the 1% rule. And I'll show you why patience, not prediction, becomes your real edge once your risk is mathematically controlled. The amateur risks big to grow fast and dies poor. The professional risks small, survives, and doubles. Then doubles again. And again. Because the system is sustainable. Because the mathematics work in their favor. Because survival always comes before growth. Which trader are you going to choose to be? Here's the first paradox that separates professionals from amateurs, and it's a hard truth that most traders never accept. You don't control your profits. You never have, and you never will. The market decides how much it wants to give you on any trade. You can have perfect analysis, flawless entry timing, and crystal clear chart patterns, and the market can still decide to chop sideways for weeks or gap against you on overnight news. You have zero control over the how much of your winning trades, but there are exactly two things you have absolute, dictatorial control over: your risk and your position size. And when you control these two variables with mathematical precision, something magical happens. The math stops working against you and starts working for you. The market's randomness becomes your ally instead of your enemy. The 1% rule is constantly misunderstood as a defensive, overly cautious approach. Traders here risk only 1% and immediately think slow growth or limited upside. They couldn't be more wrong. The 1% rule isn't about limiting your upside. It's about creating mathematical asymmetry where your winners dwarf your losers, where you can be wrong more often than you're right and still compound wealth systematically. Let me show you the numbers that fundamentally changed how I think about trading. These aren't theoretical projections or back-tested fantasies. This is the cold mathematics of survival and growth. Imagine you take 50 trades over the next quarter, following the 1% rule religiously. You're not a trading genius. You're actually struggling with your strike rate. You lose on 30 of those trades. You win on only 20. Stop right there and absorb what that means. A 40% win rate. You're wrong more often than you're right. Most amateur traders would look at those numbers and assume the strategy is broken, the account is doomed, and they need to find a new guru to follow. But watch what happens when you apply strict risk management to these seemingly poor results. You have 30 losing trades, and because you followed the rule without exception, each loss cost you exactly 1% of your account. 30 losses times 1% equals a 30% total drawdown from your losing trades. Now examine your 20 winning trades. Because your position size was manageable, because you weren't terrified of every market tick, you were able to let these winners breathe. You aimed for a reasonable 3-to-1 reward to risk ratio. Each winning trade delivered 3% to your account. 20 winners times 3% equals 60% total gain from your winning trades. The final calculation, negative 30% from losses, plus 60% from winners, equals a net positive 30% return. Your $5,000 account is now sitting at $6,500. You lost significantly more often than you won. You were wrong 60% of the time, and yet you outperformed most professional money managers while being wrong most of the time. No single trade risked more than 1%. No emotional meltdowns. No sleepless nights. No account-killing drawdowns that require 100% gains just to break even. You quietly, methodically executed mathematical asymmetry. This leads to a maxim that must become part of your trading DNA. Professionals don't avoid losing. They price it in. Amateurs think losing means they made a mistake. They treat red trades as personal failures. Professionals understand that losing is simply the cost of doing business. It's like a restaurant owner buying ingredients. The cost of food isn't a loss. It's an operating expense required to generate revenue. Your trading losses are your operating expenses. Your job is to keep those expenses fixed at 1% so your revenue from winners can cover costs and generate profit. Jesse Livermore understood this intuitively long before modern portfolio theory existed. He didn't win on every trade. He constantly took what he called probes, small positions that tested the market's intentions. Many of these probes resulted in small losses, and he didn't care. He was paying a small premium to gather information about the market's true direction. When Livermore caught a genuine move, he let it run until the tape itself told him the trend was exhausted. He didn't exit at arbitrary profit targets. He didn't close positions just because he was up a certain percentage. He stayed with winners as long as the market confirmed his thesis. But crucially, he cut losers instantly, before they could damage his psychology or his capital base. Here's why this structure works on both mathematical and psychological levels. When you risk 1%, cutting a loss becomes emotionally painless. Your trade moves against you, hits your stop, and you lose $50 on a $5,000 account. You barely notice. There's no emotional negotiation with yourself, no bargaining, no hoping it comes back. You take the tiny sting and move on with completely clear judgment. Contrast this with the amateur who risks 10% because he wants meaningful size. He's down $500 on that same account. That's real money. That's a car payment. Now his brain starts negotiating. I can't take a $500 loss, he tells himself. I'll just wait for it to bounce back to break even. He's now paralyzed by hope, unable to think clearly because his judgment is clouded by the fear of realizing that loss. While he's hoping, the stock drops further. His manageable loss becomes a catastrophic one, all because he couldn't take the small pain when it was small. The 1% rule solves the psychological problem of loss aversion by making losses too small to trigger emotional interference. It also solves the flip side, greed and premature profit-taking. When the amateur finally has a winning trade, he's terrified of giving it back. He's so traumatized by his previous large losses that he grabs any small profit just to feel the relief of a win. He cuts winners short and holds losers long, negative asymmetry that guarantees eventual ruin. But you, risking 1%, remain calm when trades move in your favor. You're not desperate to bank profits. You can afford to be patient. You can let trades breathe through minor pullbacks. You can trail stops methodically. You can capture the big moves, the 3-to-1, 5-to-1, even 10-to-1 winners, because you're not trading from fear. The amateur risks 10% and can't afford to be wrong. Every trade becomes life or death. He exits winners early from fear and holds losers long from hope. The professional risks 1% and can afford to be wrong repeatedly. She exits losers quickly because they don't matter and holds winners patiently because she's calm. Here's the compounding layer that makes this even more powerful. As your account grows, that 1% represents increasingly larger dollar amounts. You start with $5,000, so 1% risk is $50. You follow the rules. Your account grows to $6,500. Now 1% risk is $65. You're still risking the same safe percentage, but your firepower has increased by 30%. Continue this pattern. Your account reaches $8,500 after another successful quarter. Now your 1% risk is $85 per trade. You're betting bigger in dollar terms, but you're not betting riskier in percentage terms. The system compounds both safety and opportunity simultaneously. You earn the right to trade larger size by proving you can manage smaller amounts first. Most traders try to skip this progression. They want $1,000 days before they've mastered $50 days. They want to run marathons before they can walk to the mailbox. The market crushes this impatience. But if you respect the mathematics, if you embrace asymmetry, the market eventually pays you handsomely. Let me show you why most attempts at this system fail, using two traders with identical strategies. Both take 40 trades with the same entry and exit signals. Both win 18 trades and lose 22, a perfectly normal outcome. Trader A risks 1% per trade, with an average reward of 2.5 times risk on winners. 22 losses times 1% equals negative 22%. 18 wins times 2.5% equals positive 45%. Net result, positive 23% return. Trader B uses the exact same strategy, but risks 5% per trade. 22 losses times 5% equals negative 110% mathematically. But in reality, Trader B never survives to see all 40 trades. After just 5 consecutive losses, which happens to every trader, he's down over 22%. His psychology is shattered. His capital is impaired. One more significant loss, and he's either emotionally finished or mathematically eliminated. Trader A can endure 10 consecutive losses and still be down less than 10%. Annoying, but survivable. Because he survives the normal randomness of outcomes, he's present when his 18 winners arrive to more than compensate for his 22 losers. This is the hidden edge, not in your strategy, but in your ability to endure normal market randomness without self-destructing. The edge isn't in predicting what the market will do next. The edge is in structuring your risk so that what the market does next can't kill you. When you combine controlled downside with patient upside capture, you create a system where being wrong 60% of the time still generates wealth. You don't need supernatural market timing. You don't need to predict every turn. You just need decent trade selection and the discipline to let asymmetry work in your favor. Your winners will take care of themselves if you let them run. Your losers will destroy you if you let them run. The 1% rule ensures your losers can never destroy you, which gives you the psychological freedom to let your winners develop fully. But here's where theory meets reality, where knowledge becomes power or remains academic. It's one thing to understand that you should risk 1% per trade. It's entirely different to calculate that 1% correctly in real time while the market is moving and your emotions are engaged. Most traders think they're following the rule, but they're actually risking 3%, 5%, sometimes 8%, because their position sizing math is wrong. They guess, they eyeball it, they buy round numbers of shares that feel about right. Without realizing it, they've destroyed the entire mathematical foundation that makes asymmetry work. The edge we've been discussing, this entire system of controlled losses and amplified wins, depends on precise execution of your risk per trade. If your 1% is actually 3% in practice, your drawdowns get deeper, your emotions get shakier, and the attractive mathematics we just walked through collapse in real trading. That's the execution gap that kills most traders. They know the rule, but can't apply it accurately when it matters. In our next section, I'm going to eliminate that guesswork completely. I'll give you a simple, 10-second position sizing formula that ensures you know exactly how many shares to buy while keeping your risk locked at precisely 1%. No estimating. No hoping. Just mathematical certainty that transforms the theory of asymmetric returns into something you can execute flawlessly on every single trade. Most traders violate the 1% rule, not because they're reckless or undisciplined, but because they're bad at math in real time. They genuinely believe they're being conservative. They've internalized the importance of risk management. They nod along when position sizing is discussed in trading forums. But there's a devastating gap between intention and execution that destroys more accounts than any market crash or black swan event. They think they're following the rule. In practice, when you actually calculate their true exposure, they're risking 3%, 5%, sometimes 10% of their account on a single trade. The problem isn't their discipline or their commitment to safety. The problem is their calculation. They're doing the math wrong. Or worse, they're not doing the math at all. This is the invisible leak that sinks more trading careers than any other factor. You can have the discipline of a monk and the analysis of a market wizard, but if your position sizing formula is flawed, your account is mathematically doomed. You cannot manage what you cannot measure, and if you don't know exactly how much you stand to lose when your stop is hit, you're trading blind. Here's the formula that eliminates all guesswork and changes everything. Write this down. Memorize it. Make it as automatic as breathing. Maximum position size equals account value multiplied by 0.01. divided by entry price minus stop loss price. In simpler terms, your maximum dollar risk per trade, divided by your dollar risk per share, gives you the exact number of shares you're allowed to buy. Not approximately. Not close enough. Exactly. Let me walk you through this step by step, with a concrete example you can replicate immediately. You have a $10,000 trading account. You find a stock trading at $50 per share that's setting up for what looks like a perfect breakout. You analyze the chart structure and determine that the logical stop loss, the point where your thesis is clearly invalidated, must be placed at $48, just below a significant support level. First, calculate your maximum allowable risk in dollars. 1% of $10,000 equals $100. This is your hard ceiling. This is the maximum tuition you're willing to pay to find out whether you're right about this trade. Second, calculate your risk per share. You're entering at $50 and stopping out at $48. The difference is $2. If the trade fails and hits your stop, you will lose exactly $2 for every share you own. Third, apply the formula. Divide your total allowable risk by your risk per share. $100 divided by $2 equals 50 shares maximum. That's your number. Not 49 shares, not 55 because it's a round number. Exactly 50 shares. When you buy 50 shares at $50, your total position value is $2,500. On the surface, this might feel like you're committing a quarter of your account to one trade, but your actual risk, your real exposure to loss, is only $100. If the stock immediately reverses and stops you out at 48, you lose exactly 1% of your account. 50 shares times $2 per share equals $100 lost. But here's where the asymmetry emerges. If the stock moves in your favor to $56, and you exit there, you make $6 per share on 50 shares. That's $300 profit, representing a 3% gain on your account from a 1% risk. You just achieved a 3-to-1 reward to risk ratio through nothing more than proper position sizing mathematics. Now let's examine where amateurs destroy themselves with a mistake so common it accounts for the majority of blown accounts. Amateurs calculate position size based on their buying power, not their risk tolerance. They look at their $10,000 account balance and think, I can afford 200 shares at $50. That's 10,000 total, and I have that much. Or maybe they think they're being conservative. I'll only use half my buying power and buy 100 shares. Let's trace what happens. They buy 200 shares at $50. They place the same logical stop at $48. The trade goes against them, not because of any fundamental flaw in their analysis, but simply because losses are a normal part of trading. The stock hits their stop at 48. They lose $2 per share on 200 shares. That's a $400 loss. They thought they were just taking a reasonable trade. In reality, they just eliminated 4% of their account in a single move. Take 3 trades like this that go wrong, and every trader experiences losing streaks, and they're down 12%. The mathematics of recovery become brutal, and their psychology becomes desperate. This leads to the maxim that must become part of your trading DNA. Your stop-loss distance determines your position size, not your account size. This represents a fundamental inversion of amateur thinking. The amateur asks, how many shares can I buy with my account size? The professional asks, where must my stop be based on market structure, and how many shares does that allow me? The professional calculates backward from market reality. You start with chart analysis. The market structure, support levels, resistance zones, volatility patterns, average true range, tells you where your stop must be placed to give the trade room to breathe while protecting against meaningful adverse moves. The market doesn't care about your account size or your profit ambitions. The market only respects price levels and technical structure. Once the market dictates your stop placement and your account balance dictates your 1% risk limit, the mathematics dictate your share count. You have no discretionary input at this stage. You are simply the executor of the formula. Never reverse this order. Never decide you want to buy a specific number of shares and then adjust your stop to fit your desired position size. That guarantees you'll be stopped out by normal market noise. Let me share a story that burned this lesson into my memory permanently. I watched a trader analyze a breakout setup on a volatile technology stock. His technical work was genuinely excellent. He identified the consolidation pattern, spotted the volume contraction, and nailed the entry timing. The stock was trading at $100. Based on the chart structure, the logical technical stop had to be placed at $985, below the consolidation base. He had a $20,000 account, so his 1% risk limit was $200. With a $5 stop distance, the formula said he could buy exactly 40 shares. $200 divided by $5 per share equals 40 shares. But he didn't do the calculation. He looked at his buying power and thought, I want this trade to matter. I want to make real money. He bought 200 shares instead. The stock did exactly what breakout stocks often do. It retested the breakout level before continuing higher. It dipped to $95.50, held support for about 10 minutes, then rocketed to $120 over the next 2 days. It was a massive winner, exactly as his analysis predicted. But he wasn't in the trade when it happened. Why? Because when he bought 200 shares with a $5 stop, that represented a $1,000 potential loss, 5% of his account. As the stock started dipping toward his stop during the retest, he watched his unrealized loss grow. Down $200, down $400, down $600, down $800. The pain became unbearable. He couldn't psychologically handle watching 5% of his account evaporate, so he panic sold everything at $96, taking an $800 loss just minutes before the stock reversed and soared. If he had followed the formula and bought 40 shares, the maximum drawdown during the retest would have been $200, manageable and tolerable. He would have held through the normal volatility. He would have captured the move to 120, making $800 profit instead of taking an $800 loss. Same trader, same analysis, same stock, same market movement, completely different outcome. The only difference was 10 seconds of position sizing arithmetic that he skipped because he thought his intuition was more reliable than mathematics. This calculation must become as automatic as breathing. Risk amount divided by risk per share equals position size. If mental math is challenging during live market action, create a simple spreadsheet where you input entry price and stop price, and it instantly calculates your maximum share count. There's no excuse for guessing. When you trade with mathematically correct position sizing, something profound happens to your psychology. You're no longer gambling or hoping. You're executing a business plan. You know exactly what the trade will cost if you're wrong, and you've already accepted that cost before clicking buy. The emotional charge disappears. You can think clearly throughout the trade's duration. The formula also contains built-in intelligence that adjusts automatically for market conditions. If a stock is highly volatile, requiring a wide stop to avoid getting shaken out by normal price swings, the larger stop distance increases the denominator in our formula, automatically reducing your share count. The math forces smaller positions on riskier, more volatile setups. Conversely, if a stock is calm and predictable, allowing you to place a tight stop close to your entry, the smaller stop distance decreases the denominator, permitting larger share counts while maintaining the same 1% risk. The formula self adjusts your exposure based on each trade's specific risk characteristics. But mastering this defensive calculation is only the foundation. It prevents account destruction and keeps you alive in the market long enough to learn and improve. Defense alone doesn't build wealth. Defense keeps you in the game. Offense creates financial independence. Once you've internalized the art of entering positions with mathematically precise sizing, you unlock access to the most powerful wealth-building technique in trading. The real edge doesn't come from taking one perfectly sized trade and holding it. The real edge comes from using the profits from winning trades to finance progressively larger positions while maintaining your strict risk discipline. Most traders think adding to positions, pyramiding, is inherently dangerous. They associate it with gambling or reckless speculation. But when you combine the 1% rule with precise position sizing calculations, you can double or triple your exposure on winning trades while actually reducing your total risk to zero. You now have the formula. You understand how to calculate survival. You're ready to learn how to transform modest winners into career-defining trades without ever exposing your account to ruin. The amateur guesses and hopes. The professional calculates and executes. The mathematics are your pathway to both safety and prosperity. Here's where professionals separate from the pack, and it's the moment that transforms modest traders into wealthy ones. You've mastered the entry. You understand position sizing. You're risking exactly 1% on every trade. The market moves in your favor. Your analysis was correct. Now comes the decision point that separates good traders from great traders. How do you add to a winning position without turning a profitable trade into a catastrophic disaster? This is where most traders destroy themselves, not through ignorance, but through greed disguised as confidence. The amateur sees unrealized profit and gets intoxicated. Green numbers appear on the screen, and their brain starts calculating what they could make if they just doubled down right now. They think, this is my chance to make up for all those months of slow, conservative growth. The trade is working. I should capitalize on being right. They add 100 shares to their original 50-share position. They've just tripled their exposure at what might be the exact top of the move. The stock does what stocks do, it pulls back to test support. What was a small, respectable winner becomes a substantial loser. They watch in horror as their unrealized profit evaporates and turns negative. They broke the rule at the worst possible moment, when their judgment was clouded by the euphoria of being right. The professional handles this moment with surgical precision. To the professional, a winning trade is not permission to gamble more. It's an invitation to apply the same mathematical discipline that protected them on the entry. The 1% rule doesn't just govern initial positions. It governs every addition, every pyramid, every layer of additional risk. Here's the professional protocol that changes everything. You use the 1% rule for additions, not just initial entries. Every single time you add to a position, that addition must also risk only 1% of your current account balance. But there's a critical discipline that makes this bulletproof. You never add to a position until the original position is moved to break even, or better. Maxim, pyramiding is scaling into confirmation, not averaging down. Averaging down is adding to a loser because you hope it comes back. That's how accounts die. Pyramiding is adding to a winner because the market has proven your thesis correct. That's how fortunes are built. Let me walk you through the complete scenario with precise mathematics so you can see exactly how this works. You have a $10,000 account. You identify a stock trading at $50 with a logical stop at $48. Following the position sizing formula, you calculate exactly 50 shares, risking $2 per share. Total risk, $100, exactly 1% of your account. The stock moves in your favor and reaches $54. You've made $4 per share on 50 shares, generating $200 of unrealized profit. Your account balance, including this open profit, now stands at $10,200. Here's where discipline becomes everything. Before you even consider adding to this position, you must eliminate the risk on your original entry. You move your stop loss from $48 up to exactly $50, your original entry price. Those 50 shares are now completely risk-free. If the stock reverses and stops you out at 50, you break even on the initial position. You've locked in survival while maintaining exposure to unlimited upside. The stock consolidates at $54, building a small flag pattern. Then it breaks out again with strong volume, confirming that the trend has more room to run. This breakout, not hope, not prediction, but actual market confirmation, is your signal to add. Now you calculate your second position using your updated account balance. 1% of $10,200 equals $102 of allowable risk. The stock is trading at 54, and based on the new chart structure, you place your stop for this addition at $53, just below the consolidation that broke out. Your risk per share on this add is $1. Apply the position sizing formula. $102 divided by $1 per share equals exactly 102 shares maximum for your addition. You add 102 shares at $54 with a stop at 53. Examine your total risk profile now. Your first 50 shares have a stop at 50, zero risk, pure profit potential. Your second 102 shares have a stop at 53, exactly $102 of risk, which is 1% of your current balance. Your total account risk remains at 1% despite having 152 shares of total exposure. The stock continues higher and reaches $58. Let's calculate your complete results. Your first position of 50 shares gained $8 per share from 50 to 58. That's $400 profit. Your second position of 102 shares gained $4 per share from 54 to 58. That's $408 profit. Total profit, $808 on a $10,000 account. That's an 8% gain from one trade setup, where you never risked more than 1% at any decision point. You captured a move that was larger than your initial target by having the discipline to add to your winner as it confirmed itself through price action. But here's the critical insight that reveals the beauty of this system. If the stock had reversed immediately after your second entry, what would you have lost? 0 on the first position, because your stop was at break-even. $102 on the second position, because that's exactly what you risked. Total maximum loss, $102, or roughly 1% of your account. This is asymmetric risk at its finest. Your downside on the entire trade, even with 152 shares of exposure, was capped at 1%. Your upside was theoretically unlimited and practically substantial. You risked 1% to make 8%. Jesse Livermore understood this principle better than perhaps any trader in history. He called it pyramiding up, and he built one of the greatest trading fortunes ever using this exact approach. Livermore would establish a small initial position, what he called a probe. If the market moved in his favor and confirmed his thesis, he would add another small position. If the trend continued with strength, he would add again. His largest wins didn't come from one massive all-in bet where he risked everything on a single prediction. His largest wins came from 3, 4, sometimes 5 separate additions to the same trend, each addition sized appropriately for the risk at that moment. Each previous position moved to safety before the next addition. Livermore's genius was understanding that you don't need to predict the full extent of a move before it happens. You just need to recognize when a move is happening and have the discipline to participate proportionally as it unfolds. Start small. Let the market prove you right. Add systematically. Protect what you've already made. Repeat until the trend exhausts itself. The psychological advantages of this system are profound. When you pyramid properly, you're no longer gambling or hoping. You're executing a business plan where each decision is mathematically justified. Your original entry becomes risk-free before you add size. Your additions are financed by the market's own confirmation of your thesis. You're leveraging the market's money against itself. Compare this to the amateur's experience. The amateur holding a massive position from the start is sweating every tick. He can't leave his desk. He can't sleep. He exits winners too early from fear and holds losers too long from hope. The professional holding a pyramided position remains calm. Her original entry is risk-free. Her additions are protected by tight stops. She's relaxed because she has nothing to lose and everything to gain. But here's the critical warning that determines whether this system builds wealth or destroys accounts. This only works on clear, strong trends with genuine confirmation. You cannot pyramid in choppy, sideways markets. You cannot add to positions simply because they show unrealized profit. The market must earn your additional capital through demonstrated strength, breakouts, continuation patterns, volume surges, or other objective technical signals. If you try to pyramid every small winner, you'll get stopped out of additions repeatedly and churn your account to death. This technique requires the discipline of a sniper. You wait for the perfect setup. You enter small. And only when the market screams confirmation do you unleash the heavy artillery. The beauty of this system is its resilience and selectivity. If you're wrong on an addition, you lose 1%. If you're wrong on the initial entry, you lose 1%. But if you catch just 1 or 2 properly pyramided trends per year, the mathematics cover dozens of small losses and still leave you with exceptional returns. You're participating proportionally to the opportunity. A small move gets a small position. A massive move gets massive exposure. You're aligned with market reality instead of fighting it. This is how you double a small account safely. Not by taking huge risks on single trades, but by squeezing every ounce of profit out of your winning trades while keeping your risk locked in a mathematical cage. You let the market pull you deeper into positions only as it proves you right, step by step, confirmation by confirmation. But there's one final piece to this puzzle that determines whether you merely understand these concepts or actually profit from them. You now have the defensive foundation, 1% risk per trade. You have the offensive weapon, pyramiding into confirmed winners. But none of this matters if you're constantly deploying capital into mediocre setups just because you're bored or feel like you should be doing something. The missing ingredient, the skill that separates wealthy traders from broke traders with good systems, is the ability to do absolutely nothing when the market offers no edge. This isn't passive patience. This is active, weaponized patience, the kind that acts as a filter, protecting your capital from subpar trades so that when the perfect pyramiding opportunity arrives, you have the money and mental clarity to execute flawlessly. The 1% rule will save you from blowing up your account. Pyramiding will amplify your winners into career-defining moves. But patience, true weaponized patience, is what transforms a good system into a wealth-building machine. This is the final gate that separates amateurs from professionals, and it's the hardest skill to master because it goes against every instinct modern culture has programmed into us. Most small account traders suffer from a psychological compulsion that destroys more accounts than any market crash or black swan event. They feel that if they're not actively trading, they're not really working. If their account is flat with no open positions, they experience a form of financial FOMO that drives them to force trades in suboptimal conditions. They stare at charts and hallucinate patterns in random noise. They chase setups that are pretty good instead of waiting for setups that are exceptional. Even with perfect risk management and flawless position sizing, they slowly bleed their accounts to death through accumulated commissions, slippage, and dozens of unnecessary small losses. You must internalize a maxim that sounds simple but represents a fundamental shift in identity. Cash is a position. Waiting is a position. When you're holding cash, you're not missing out or sitting on the sidelines. You're occupying the most powerful position in the market. Complete flexibility. You're uncommitted capital waiting for a genuine edge. You're a sniper lying in the grass, not a soldier running blindly across an open field firing at shadows. The amateur equates activity with progress. The professional understands that the market rewards stillness more than movement. Jesse Livermore, whose principles form the backbone of everything we've discussed, captured this perfectly. It was never my thinking that made the big money for me. It was always my sitting. Think about what he's revealing. Livermore was arguably the greatest market analyst of his generation. He could read tape like a native language. His pattern recognition was legendary. Yet he's telling you that his analytical genius wasn't his edge. His ability to sit patiently and do absolutely nothing when conditions weren't perfect was his edge. The hardest skill in trading isn't chart reading, or entry timing, or stop placement. The hardest skill is the discipline to close your trading platform and walk away when the market offers no genuine edge. It's having the confidence to hold cash while other traders frantically enter and exit positions, convincing yourself that inactivity is strategic positioning, not laziness. Let me prove this with mathematics that will change how you think about trade frequency forever. Picture two traders with identical $10,000 accounts, both following the 1% rule with perfect discipline. Trader A feels the psychological pressure to stay active. Over 3 months in a choppy, range-bound market, he takes 100 trades. He's not reckless. Every trade risks exactly 1%. But because he's forcing action in suboptimal conditions, his edge is minimal. He wins 45 trades and loses 55. His average winner makes 2% because trends don't develop in choppy conditions. His average loser costs 1% due to disciplined stops. The mathematics, 55 losses at 1% each equals negative 55%. 45 wins at 2% each equals positive 90%. Net result before costs, positive 35%. But 100 trades at $10 commission per round trip equals $1,000 in fees, 10% of his starting capital. His actual return drops to roughly 25%. More importantly, Trader A is psychologically destroyed. 3 months of constant screen time, 100 separate emotional cycles, the mental exhaustion of forcing trades in unclear conditions. His decision-making quality is deteriorating. He's starting to cut winners early from fatigue and hold losers too long from hope. Now examine Trader B. She takes only 20 trades during the same 3-month period. She waits exclusively for what she calls A-plus setups, clear breakouts from major consolidation patterns with volume confirmation, decisive rejections at multi-tested support levels, momentum thrusts following genuine catalysts. Because she's selective, her win rate improves. She wins 12 trades and loses 8. Her average winner makes 4%, because she's trading genuine trends where she can pyramid and let positions run. Her average loser still costs 1%, because she maintains identical stop discipline. 12 wins at 4% equals positive 48%. 8 losses at 1% equals negative 8%. Net result, positive 40% before costs. 20 trades at $10 commission equals only $200 in fees, 2% of starting capital. Her actual net return is approximately 38%. She outperformed Trader A by 13 percentage points while taking 80 fewer trades, spending far less time in front of screens, and maintaining crystal clear judgment throughout. The difference between these traders isn't analytical skill or risk management. Both are identical. The difference is selectivity. Trader B understands that not all setups are created equal, and that trading mediocre conditions is just a slow way to lose money even when following perfect rules. Your job is to identify what Livermore called pivotal points, specific moments when the market tips its hand with unusual clarity. These aren't random fluctuations or minor pullbacks. These are structural shifts where supply and demand become wildly imbalanced, creating the conditions for sustained moves that generate real wealth. A pivotal point might be a stock breaking out of a 6-month consolidation base on triple normal volume, or a market testing a major support level for the 4th time, then violently rejecting it with institutional-sized buying, or a momentum thrust immediately following surprise earnings where price gaps up and then continues running instead of filling the gap. These setups scream something important is happening, rather than whispering, maybe something might happen. When you combine all 3 elements, the 1% rule that prevents catastrophic losses, pyramiding that amplifies confirmed winners, and patience that ensures you only deploy capital on premium opportunities, your account transforms from linear growth to exponential compounding. Start with $5,000. For the first quarter, you might take only 8 trades. You're patient. You protect capital religiously. You catch one genuine trend and pyramid into it properly. Your account grows to $6,800. It feels slow. You fight every instinct to accelerate the process. Continue the discipline. Your account base is now larger, so your 1% risk represents more dollars, 68 instead of 50. Over the next quarter, you catch another quality trend. You scale in as it confirms. The market rewards your patience. You end the period at $9,200. 6 months later, following the exact same boring, repetitive, disciplined process, you reach $15,400. The doubles start coming faster, not because you're taking more risk, but because the mathematical base is larger and the system remains sustainable. You're no longer fighting to recover from devastating drawdowns. You're building wealth on top of a fortress. Here's your complete system, distilled into 4 non-negotiable rules. First, risk 1% maximum per trade. This ensures you survive the inevitable losing streaks that destroy amateur accounts. Second, calculate position size from your stop-loss distance, not from your buying power. This ensures your risk is mathematical reality, not wishful estimation. Third, pyramid into winners only after moving your original stop to break even or better. This allows you to capture massive upside with 0 additional risk to your principal. Fourth, wait for pivotal points and A-plus setups. Reject random noise. Treat your capital like ammunition that's only fired when the target is clearly visible and vulnerable. You don't need to be right more often to build wealth. You need to be right when it matters, on the high-probability setups that offer genuine asymmetric potential. You don't need to take bigger risks to grow faster. You need better timing and superior selectivity. You don't need more trades to feel productive. You need more patience to avoid the mediocre trades that slowly bleed accounts to death. The amateur chases quick doubles through oversized positions and constant activity. He blows up within months, refunds his account, and repeats the cycle indefinitely. The professional follows the 1% rule with religious discipline, pyramids into confirmed winners, and waits patiently for premium setups. She doubles her account safely, then doubles again, because the system survives and compounds over time. Your edge in this market isn't prediction. You cannot consistently forecast what happens next, and you don't need to. Your edge is position sizing discipline that caps downside at 1% per trade, combined with the patience to wait for setups offering 5-to-1 or 10-to-1 asymmetric potential, combined with the skill to pyramid into those winners as they confirm through price action. This is how you double a small account safely, not through gambling or hope or heroic predictions, but through mathematical discipline and patient execution. The market will give you everything you need if you're willing to wait for it and structure your risk properly when it arrives. Cash is a position. Waiting is a position. And sometimes, doing absolutely nothing is the most profitable decision you'll make all month. The amateur dies quickly from impatience and oversized bets. The professional builds lasting wealth by respecting the mathematics of survival and letting compound growth work its magic over time.